Chapter 4: Fundamentals of Cost Analysis for Decision Making. In the prior chapters, we studied CVP analysis, cost volume profit analysis. And so now that you're comfortable with CVP analysis and the impact of fixed versus variable costs, we can extend the concepts and apply the theories to a multitude of different business conditions. One new concept is differential analysis. Differential has the same root word as the word difference. And so what we do is we look at two different scenarios and compare the revenues and costs for those two scenarios and determine what the difference is between the two. And then we go with the better option. Another new term in the chapter is short run. Often you'll hear this term compared to another term, long run. Generally, short run refers to a time period where capacity is not going to change. Remember, we talked about fixed costs and variable costs. Fixed costs are costs that are unchanging within a relevant range, a certain number of items produced, and also within a certain time period. As we discussed previously, a fixed cost is fixed for a certain time period, but if you extend that time period long enough, any fixed cost is a variable cost. So, for example, if you have an office space that you're renting and you sign a 1-year lease, well, during that year, that office rent is a fixed cost. But if you have a time period that's longer than a year, let's say a 5-year time period, well, that might be considered a variable cost since you only have to sign 1-year leases. So a lot of the examples that we look at in this chapter and a lot of the problems that we look at are going to deal with short run scenarios. When we're looking at two or more different alternatives, remember that in a differential analysis, we're looking at differences in cost. So if you have different expenses, the ones that change between scenarios are going to be what we consider in a differential analysis, and the ones that stay the same really have no effect for our purposes. Expenses that stay the same are irrelevant for a differential analysis, and the differential costs are relevant, which is why they are sometimes called relevant costs. A sunk cost is a cost that's already occurred. It's in the past. So this sunk cost can't be changed for the present or the future. The important thing about a sunk cost is that it is not relevant. It's a logical concept, but it can be hard to understand at first. So again, if there's a cost that you've already incurred and paid for, and it shouldn't affect any future decisions. The example I like to use is at a grocery store. Let's say you stand in line at register 1 waiting to check out, and you've stood in line for 10 minutes. After 10 minutes, you still have a few people in front of you, but register 2 opens up, and you can walk over to register right away and check out. Now, some people in that scenario might say, well, I've already been in line 1 for 10 minutes. I might as well just stay here. But you should be able to tell that that's an absurd position. It doesn't matter that you've already stood in line 1 for 10 minutes. If line 2 is open and you can be served immediately, then it would be in your best interest to move to line 2. Another pertinent example might be, let's say you're a manufacturer and you're developing a new piece of machinery that'll make your factory run a lot more efficient. Let's say you've spent $100,000 on this piece of machinery and you need to spend another $100,000 to finish it. Well, at that point, let's say that a competitor has developed their own piece of machinery that produces the results that you were looking for, and they're willing to sell you their machine for, let's say, $10,000. So what do? Do you spend another $100,000 to finish your own piece of machinery, or do you just spend $10,000 to purchase that piece of machinery from your competitor? Well, if we're just considering the sunk cost concept, we should know that the correct answer would be to buy the $10,000 piece of machinery. It doesn't matter that we've already spent the $100,000 and now we have to spend another $100,000 to finish our own piece of machinery. That $100,000 that we've already spent is a sunk cost, and it should not play into our decision making for the future. So again, if we're faced with a situation like this, either spend $100,000 to finish creating our own machinery, or just buy the competitor's machine for $10,000. We should just buy the machine for $10,000. Now in the real world, there might be other considerations. Maybe if you develop your own piece of machinery, you can make certain that the bought machine can't be adjusted for. Or maybe there are issues with patents. Perhaps you are developing a patent related to the piece of machinery and you want to finish your research and development. So as we know, in the real world, there could be other issues that would be considered in this decision. But again, if we're just considering sunk cost, everything else equal, ceteris paribus, we know that we should go with the $10,000 piece of machinery that we would purchase from the competitor. This slide shows us a table with two different alternatives that we're considering. And to highlight the difference between differential costs and irrelevant costs, we can look at fixed costs. In the case of fixed costs, it doesn't matter if we choose alternative 1 or alternative 2. Fixed cost is $350 under both scenarios. So in this case, fixed cost is not going to be considered in our differential analysis. Things that do change are sales revenue. That changes, so that's something that we would consider. Variable cost is different, and so that also makes contribution margin different. So again, the differences are something that we would consider when trying to decide which alternative to choose. But something like fixed costs, since that's the same, that's not going to play into our decision. Here's a concept that should be common sense, but it's still helpful often to actually hear the concept spoken or written down. This slide talks about how to set a price for an item. There are two considerations here on this slide. One is that variable cost must always be covered. And so again, that's common sense. If you're selling a hamburger and the bun, the meat, the toppings, and the condiments cost $2, well, you have to sell the burger for at least $2 to cover your variable cost. You actually would need to sell it for at least $2.01 to make any sort of progress in your business. But the bare minimum would be $2, so at least you're breaking even. If the burger cost you $2 in variable cost and you can only sell it for $1.99, well, then you need to shut down your business because you're not going to be able to generate any profit or contribution margin. The second concept is that fixed cost must be covered in the long run. So again, fixed cost is something like rent and utilities to a certain extent. So again, we use the hamburger example. If your variable cost for the hamburger is $2, then you need to sell the hamburger for more than $2. Let's say you sell it for $4. Then you're making a $2 contribution margin per burger. And remember that that contribution margin goes to cover fixed costs, and then it will contribute to your profit amount. So if your burger costs you $2 in variable cost and you sell it for $4, you make a $2 contribution margin, and then you have to figure out how many burgers you need to sell in order to cover your rent. So again, the first battle is to make sure that your variable costs are covered. But the second battle, which is just as important, is that your fixed costs have to be covered in the long run. Another example is the small gym that I used to own. The franchise would require us to charge at least $30 a month per member. And again, in a gym, the variable cost is actually pretty small. So for every member that would pay $30 to the gym a month, they probably used a minimal amount of toilet paper and paper towels and hand sanitizer. So most of that $30 of revenue that I would get from each member would go directly to the contribution margin. So again, that's battle number one. Battle number two is that your contribution margin for every member needs to cover your fixed costs. And I calculated that we needed probably about 350 members or so in order to cover the rent plus utilities plus salaries paid to the staff. But unfortunately, we could never get to that point. So it was quite easy in the gym to overcome concept number one, since the revenue from every member was virtually pure contribution margin. But the problem was battle number two, in that there was not enough members to cover fixed costs. And actually, that's an issue in the gym industry for most of the locations. Gyms generally require a lot of space, which leads to higher rent. And then there's also equipment and machinery to buy for each gym. So most gyms are generally not profitable, or if they are profitable, the profit's really not that much to speak of. For pricing decisions, you can generally divide them up into two categories, short run versus long run. Short run is something like a special order, something that you can generally fit into your existing business model, something that you can just add in with minimal adjustments. Compared to a long run pricing decision, something like that might be adding a new product line. Obviously, that's not going to be a short run decision. It could include needing to rent out more space for the new product line, adding more machinery, more employees, etc. So for short run, generally fixed costs are going to not change, whereas in the long run, as we've discussed, almost every cost becomes a variable cost. For special orders, the book gives the definition of an order that will not affect other sales, and it's usually a short run occurrence. And that's generally true, but we'll see in our homework that a special order can affect other sales. And so if you're producing product A at capacity and now you get a special order for product B, you might have to cut back on the amount of units that you create of product A in order to make time for product B. Here's an example of a special order. This tour company usually sells their tours for $900 per tour. They receive a one-time offer for 5 tours for $700. And so that's something that's commonplace in the real world, where people will ask for a discount if they buy in bulk, or in this case, buy multiple tours. And so we need to determine if it would be a good idea for them to accept this offer. Tours are generally sold for $900. They want it for $700, so they want a $200 discount. The variable cost is $300. So the total contribution margin for 20 tours is $12,000, but per tour that would be $900 sales minus $300 variable cost. So we would have a $600 contribution margin per trip. So even if we lower the price by $200, that still gives us a $400 contribution margin. So it does seem like it would be a good idea. And so this slide shows us the numbers if we were to not take the special order versus if we do take the special order. The numbers look pretty good. Your sales revenue will go up. Variable cost also goes up because each tour has costs attached to it. Your total contribution margin increases. Your fixed cost stays the same, so you didn't have to hire any additional employees for the tour. And so your operating profit goes up by $2,000 by taking this special order. So overall, it looks like it's a good idea. As we've discussed in the past, in the real world there are other considerations. One thing we've discussed before is that some companies don't like discounting their prices, because some customers, when they get discounts, they become addicted to those discounts. And we've talked about different types of businesses. Some businesses will want to sell items at a premium product, and they would charge a lot for it, even though that they know that they're not going to sell that much of it because of the premium price. Whereas other companies will sell at a lower price with smaller profit margins, but they know that they're going to sell a lot of their item or their product. One example I can think of a company that loves charging premiums is Apple, their iPhone Pro. It doesn't seem to me that they care about price on the iPhone Pro, and it seems that their customers, their loyal customers, don't care about the price either, so that's why the price keeps going up and up. Apple doesn't really care too much about discounts. I rarely see discounts on iPhones until the new model is out. And so you compare that to other phone companies that, let's say, they sell the disposable phones, or not disposable, but rechargeable phones with rechargeable minutes. And so now you can buy a phone for like $50 at Walmart. And so variable cost wise, I would seriously doubt if the iPhone really costs so much more to produce than one of the cheaper phones. But the iPhone has name brand recognition, and they're known to be a premium product, so they can charge more. And so Apple doesn't want its clientele to get used to discounts or coupons. And so if this tour company takes the same approach, they might choose to not discount the special order. But for our purposes, if we're just looking at operating profit, then we would go ahead and take the special order. For long run pricing decisions, we're going to look at the full cost of manufacturing and selling a unit. Again, the full cost is going to include fixed cost and variable cost. Full costs are relevant for long-term pricing because, as we talked about, when we have, in the long run, pretty much all expenses, all costs are variable costs. In the long run, you don't have fixed costs. Everything becomes an option if you stretch out the time period long enough. And so in the short run, differential costs might be low because, again, you're going to have a lot of your costs as being fixed. Whereas in the long run, your differential costs are higher because a lot of those fixed costs are going to be reclassified as variable costs. This slide says that in the long run, the company must cover all variable and fixed costs. And so we compare that to the short run, where when we're doing differential analysis, remember that costs that stay the same aren't included in the analysis. So if a cost is fixed, it's not going to be a consideration in determining whether to do a short run order like a special order. But in the long run, since virtually all expenses become variable expenses, then those fixed costs would also come into consideration. Target costing from target pricing. In this approach, the company takes somewhat of a backwards approach or a reverse approach. What a lot of companies do is they look to see how much it costs to sell or create a product. They add up all of their costs, and then they figure out what type of profit margin that they want, and then they price their product accordingly. So they look at cost first and then set the price. Target pricing, however, takes the opposite approach, where they look to see what the market considers an item might be worth, and then they work backwards. They figure out how to make those costs fit within a certain range, and so that's called target costing. So again, the regular approach is to add up all the costs, figure out how much profit you want, and then try to set the price of your goods at that price. But target pricing works backwards in that you look at what the market is willing to pay for an item, then you try to set your costs at a certain level so that your price covers those costs plus your desired profit. These are three different types of scenarios that we use differential analysis in. One is make or buy, meaning that a company often can make their own products in-house or they can buy it from somebody else. Two is add or drop a segment, and that's where a company either sells or makes different lines of products, and they have to determine going forward whether to keep all of those lines or drop one or add one. And then number three is product choice, and then that we have to determine what the optimal product mix is. So a company that might sell 2 or 3 varieties of a certain item would look to see which of those items are more profitable, and then they would try to, of course, sell more of those items than the less profitable ones. So here's an example of a make or buy decision. There's a tour company called Desert Adventures. The labor cost per tour is $300, food is $4, and supplies is $3. So that's $1,000 per tour for variable cost. Then you have your fixed direct cost and also common costs allocated to this service for a total cost of $222,000. So if the company sells 150 tours, that comes out to $1,480 per tour. But now a local tour operator approaches Desert Adventures and asks them if they would like to outsource these tours to them for $1,400 per tour. Should Desert Adventures accept the offer? Well, the previous slide showed that if we do 150 tours, the price per tour, the cost per tour, would be $1,480. So if this local tour operator charges only $1,400 per tour, then that's a savings of $80 per tour. But the accounting department also is going to prepare an analysis for if we do 100 tours, which makes sense because often what we predict doesn't come true exactly. So even though we might plan for 150 tours, it could very well be less than that. This slide shows us the costs if we do 150 tours. If we operate the tours ourselves, then we're going to have labor cost and food cost and supplies of $45,000. We're also going to have direct fixed costs of $48,000. If we don't do the tours ourselves, then we're not going to have that labor, we're not going to have that food cost, and we're not going to have the $45,000 in supplies, but we will have the $210,000 paid to the other tour company. 150 tours times the $1,400 price that they gave us is $210. We're not going to have the direct fixed costs, but we still have the common costs. Common costs can be something like costs related to the accounting department or the payroll department. So those costs wouldn't change whether we conduct the tours ourselves or we outsource the tours. So if we do 150 tours, it's better to do the tours ourselves because the sales price minus the variable cost of the labor, food, and supplies gives us plenty of contribution margin to cover the common costs and the fixed costs. So we actually come out $12,000 better if we operate the tours ourselves, assuming that we do 150 tours. Now let's see if we only do 100 tours. If we only do 100 tours, again, our sales revenue is going to be high enough to cover our variable costs. So we do have a contribution margin, but we have less contribution margin to cover our fixed costs. And so we compare that to if we outsource the tours, they're going to charge us $140,000, and then we're still going to pay the common cost of $24,000. So in this case, it's better to outsource the tours. If we only do 100 tours, the profit that we get from each tour, if we only do 100 tours, then the fixed costs that we have are spread out among only 100 tours instead of 150 tours. And so the fixed costs per unit or per tour is a lot higher. And when we do the math, we see that it's better off if we only do 100 tours to outsource it. So in a situation like this, the company has to really make the best forecasting that they can do to determine whether they're going to do 150 tours or 100 tours. And if it's looking like they're probably going to do 150 tours, then it's better to keep doing the tours themselves. But if they expect a decline in demand, then it would be better to outsource. Here's another scenario with the same company. Desert Adventures has desert tours, rafting tours, and aerial tours. And a quick glance shows that the aerial tours make a profit, rafting tours make a profit, but the desert tours result in a loss. So we have to determine whether or not to keep or drop the desert tours. It seems like, at first glance, that we should drop the desert tours if it's losing money, right? But don't forget that some costs are variable, but there's also fixed costs. So we have to take into consideration that if we shut down our desert tour line, which costs, if any, are going to disappear and which costs are going to stay. So it's not so simple as to just looking at the bottom line, negative $8,000 operating loss. So here's the analysis. If we keep the desert trips versus dropping that line, our sales revenue is going to go down, of course, but so will variable costs because those are attached directly to the tours. But here we see that rent is going to be the same. So whether we keep this line or we drop it, we're still paying $150,000 in rent. Salaries go down, marketing costs go down. So again, most costs and the revenue goes down, but the rent stays the same. So when we crunch the final numbers, the company makes $126,000 in profit if they keep the desert trips, but we only make $105,000 if we drop the desert trips. So we lose $21,000 in profit if we stop doing desert trips. So fixed costs can be a tricky thing. Even though a profit and loss statement might show a loss for a certain product line, if some of those costs are fixed and they're going to be there whether or not you have that product line, then it might be actually beneficial to keep running that product line, even though overall it shows a loss. Next, we're going to talk about product choice decisions. One thing to consider are constraints. Constraints are activities, resources, or policies that limit a certain objective. So in the case of a manufacturer, we might have a machine that we can only run for a limited amount of hours. We might have a production process where the first stop there's a bottleneck. And so even at the second stop, if they're able to produce more, they can't because they're waiting for the products from the first stop. Or it could be a constraint like market demand. If a company can produce 10,000 of a certain item, but the market only wants to buy 9,000 of an item, then that could be a constraint as well. For contribution margin, we've talked about contribution margin per unit of item that's sold, but you can also calculate a contribution margin per unit of a particular input. So let's look at an example which illustrates contribution margin based on input. In this example, we have a company that sells metal frames and wood frames. The metal frames are $50 and the wood frames are $80. So wood frames are more expensive, but also their costs are more expensive, and they're proportionately more expensive than the metal frames. So despite the higher price of the wood frames, the contribution margin for the wood frames is exactly the same as the contribution margin of the metal frames. So at first glance, it looks like it doesn't matter if you sell a metal frame or a wood frame, you're equally happy selling either one. But now they give us additional information. To produce a metal frame, it takes half an hour. But to produce a wood frame, it takes the machine 1 whole hour. So the machines can crank out metal frames twice as fast as a wood frame. So that means that if you have to run your machine to create metal frames or wood frames, assuming that you have enough demand in the market that will buy these frames, it's better off if you create metal frames, since you have a higher contribution margin per machine hour. You can crank out 2 metal frames in an hour with your machine versus just 1 wood frame using the same machine. So assuming that you can run this machine for 20,000 hours per month, the most number of metal frames you can produce is 40,000, and the most number of wood frames is 20,000. And considering that they both have the same contribution margin, then your operating profit is going to be way higher if you produce metal frames than wood frames. Now again, this also depends on whether the market wants to buy 40,000 metal frames from you. If they do, then you're better off creating 40,000 metal frames. If they don't want to buy 40,000 metal frames and they want to buy some wood frames, what you would want to do is figure out how many metal frames maximum that the market will buy, produce those, and then for the remaining machine hours you can make wood frames. So you max out the more profitable item, and then your remaining resources you can use for your other lines. So I know these concepts can be confusing, but hopefully when we do the homework and put more numbers to it, it'll become more clear. And we'll even have a homework problem regarding product choice decisions like this one.